Capital markets. Chapter outline will cover capital market and securities, fundraisers and capital markets, the three-sector economy of the United States, physical and electronic markets, and rapid adjustment of prices and is an indication of efficiency. Security markets. They consist of a myriad of securities from government bonds to corporate common stock. They're all influenced by variables like interest rates, investor confidence, economic growth, and global crisis. All of these can affect the change of securities and government bonds to corporate common stocks. Interest rates could be the interest rates of the Federal Reserve indicates. Investor confidence is how well our consumers feel about investing in the stock market. Economic growth is GDP growing nationally, regionally, focusing on international growth. And then global crises. Anything such as a national crisis such as Hurricane Katrina could be something that affects the economy of the United States, but a global crisis could be a war that breaks out in Syria that could affect the change in these different securities. Types of security markets include money markets and capital markets. Biggest difference between these two is money markets is short-term and capital markets is long-term. Money markets will look at shorter in terms of a maturity of 1 year or less. They include treasury bills, commercial paper. And when I say negotiable certificates of deposits, you're looking at a certificate of deposit of 12 months or less. Capital markets are longer term. They include bonds, common stock, preferred stock, convertible securities. These securities comprise a firm's capital structure typically. International capital markets emerge as a result of adoption of basic principles of capitalism, global privatization, reduced telecommunication costs, and continuing development of international free trade. We say telecommunication cost, the internet was a big changer in terms of creating an international market. It made the telecommunications virtually free for everyone. Another, when we talk about free trade, establishment of NAFTA in 1994, the North America Free Trade Agreement, which allows free trade between Canada and Mexico and Latin American countries into the United States. CAFTA reduces trade barriers. The 6 original members of EU abolished internal tariffs in 1968. The World Trade Organization strives to further liberalize international trade, and then the Eurozone and embrace the euro, the official currency for the 16 Eurozone countries. This is what created their international capital markets that we currently have today. International capital markets is a source of funds. They're an opportunity for companies to raise debt and equity capital at the lowest costs. Many list their common stock around the world to increase liquidity for the stockholders, provide opportunities for the potential sale of new stock in forward countries. About 3.8% of foreign investments, that's about $885 billion, has been invested in government securities. Competition for funds in the U.S. capital markets. Securities available in the capital market: the federal government, government agencies, state governments, and local municipalities. Investors must choose among corporate and non-corporate securities with the desire to maximize returns for any given level of risk. Government securities. U.S. government securities include Treasury, most popular T-bills. Manages the federal government's debt in order to balance the flow of funds. Sells short or long-term securities to finance shortfalls or retires in case of surplus. Federally sponsored credit agencies. Governmental units issuing securities on a separate basis from those sold by U.S. Treasury includes Federal Home Loan Banks as an example of one. Federal National Mortgage Association, also known as Fannie Mae, is another. Federal Home Loan Mortgage Corporation, or Freddie Mac, is another. Farm Credit Banks. Student Loan Marketing Association, Sallie Mae. I'm sure many of you maybe have Sallie Mae government securities for loans. Federal Agriculture Mortgage Corporation, or Farmer Mac. State and local securities, municipality securities, or tax-exempt offerings to improve investor confidence because they get tax advantages because of that. Purchased by investors in high marginal tax brackets, supported by revenue generating projects. Corporate securities. Corporate bonds. Debt instruments having a fixed life and to be repaid at maturity. As bond comes due and are paid off, the corporation normally replaces this debt with new bonds. Preferred stock. Least used of all long-term securities since the dividend is not tax deductible to the corporation. Preferred stock is also kind of a hybrid between corporate bonds and common stock. Common stock is sold by companies desiring a new equity capital, either sold as a new issue in an initial public offering or as a secondary offering. Treasury stock is a company purchases its own stock back as a reinvestment. Common stock has no maturity date in terms of any kind of payment coming out. The way you get rid of common stock is either a company becomes insolvent and it becomes literally useless in terms of value, or you sell it in a secondary market to make your money back, or you could also sell it back to the company. End part 1.